Nice to see everybody. Mid-April here, as you can see, a beautiful sunny day in the Okanagan. We've all been busy traveling. Jay, Clark, myself, kind of global travel over the last little bit. Jay, what have you been up to?
Spring break, went to down to California. They let us across the border, which was a good sign. Relations haven't gotten too bad. So yeah, nice little spring break with the kids down in some sunshine, and now we're back here to spring weather in Canada.
Same thing, they let me into the States. That was to Hawaii, where it didn't really feel any different other than probably 30% more expensive than it was last year. At least that's how it felt. And then earlier this week, or I guess last night, got back from a great conference we do every couple of years. This year it was in Montreal. Bring together 50 advisors from Raymond James globally. So it's a really good opportunity to network with some of our US colleagues that we don't normally do, and bring in some great speakers and a lot of good information, which I'll share with you guys. But some speakers on artificial intelligence, just typical economic outlook things as well. So it's very useful.
Wonderful. We traveled off to Costa Rica for the first time, which was nice. We circumvented the U.S. there, and the direct flights out to Toronto, which was, for those who haven't been to Costa Rica, fabulous spot to travel. Lots to do, surfing and ATV and zip line and fishing, you name it. It's a whole host of activities.
You got the kids up on surfboards.
Yeah, they're much better than Dad, I'll tell you that much.
Yeah, it's a little tougher when you're the age that we are, and trying to get up there. Your kids do it like
Yeah.
It's
I
cool.
find I'm losing my balance the older I get. That's the biggest thing. Jay, as you were traveling last night, I thought I'd take the reins and host today. So welcome everybody to episode number 21 of Plena Wealth Talk. Obviously, lots to talk about today. Lots gone on since our last podcast. Lots of questions amongst the investing public. Why don't we kind of dig right into it and go through a breadth of what we're going to talk about. So Jay, Clark, where do we start here? Volatility, equity markets. Give us your thoughts.
Yeah, I guess since the last podcast about a month ago, the name of the game has been volatility, uncertainty arising from Liberation Day down in the US, and the impact that's had on markets as the Trump team came out with significantly higher tariffs than what was expected. And that obviously had a big impact on markets around the world, particularly in US markets, where we saw a lot of the kind of leaders of the last year really taking a step back. So the technology names have been hurt maybe the most out of any sector. But broadly speaking, we've just seen a big kind of shift in the markets where with the growing uncertainty, like we see from time to time, when things get scary, people make irrational decisions. Maybe they can be rationalized given the context of the situation, but sell first and ask questions later is often the playbook. And it's unfortunate to see the markets fall as much as they have. For long-term investors like us, though, we look at these periods of time as opportunities. And that's kind of what we've been trying to relay to clients with some communications that we've been sending out on an ongoing basis. So lots happening kind of within the equity markets. Bond markets as well have been quite active, with bond yields dropping through the first kind of 2.5 months of the year, and then with this kind of recent change in policy. One of the big things that we saw through that kind of first week of volatility was interest rates on US Treasuries actually started rising, which was something that I think really spooked the markets. So typically when we see equity markets fall or go through periods of volatility like this, what kind of the average investor is often doing is selling their stocks and buying bonds. And the impact of that is actually to push bond prices higher and yields lower. What we saw really, though, is in the kind of spike of volatility last week, the opposite started to play out as interest rates actually on US Treasuries started to rise. And that led to a lot of commentators suggesting that there was some concern about the faith of the US Treasury to be able to repay its debts. There's some inflation data that was mixed in there. There's obviously a lot going on with global flow of funds, where people and investors are positioning themselves. But the kind of big theme of the last month has been uncertainty and the impact that's had on all asset classes. So it's been a whirlwind of a month.
I think the key thing there, the key word, Jay, is what you just said, which is uncertainty. Markets don't like uncertainty. Investors don't like uncertainty. Business leaders don't like uncertainty. And that's the environment we find ourselves in. I think, prior to us recording the last podcast a month ago, markets had already corrected, knowing that we would have tariffs to some degree. And I think, Liberation Day, as it's been come to be known, was these tariffs and the way that they were calculated by each country was never expected to that extent. But I think since then, I think that the market volatility, whether it's in equities, whether it's in bond yields, is a reflection of the uncertainty out there. And I talked last time about kind of the rule of 72 hours, which is when the Trump administration indicates something kind of before you adjust or react, kind of give it a few days, because you don't know if that's going to be changed or not. And you look at, the volatility with a stock like Apple, and Apple, is definitely one of the companies that is probably the most exposed to tariffs, and they've got this huge complicated supply chain. And one day it's down 10% on the announcement of these tariffs on Liberation Day. Then it's up 15% when these tariffs a few days later are called off for 90 days. Then it's down again, and then it's up again 10% when the administration announces that chips and smartphones and laptops, et cetera, would be excluded from these tariffs. And in this kind of environment, whether you're a business leader, whether you're a portfolio manager, whether you're an investor, how does one make decisions with that degree of uncertainty day to day? That's part of the reason why we advocate, although it's difficult at times, you can't react to this kind of news. And if you're a business leader, and we've seen it with earnings and earnings forecasts by companies, where they just pull their outlook and they don't know what things are going to look like a month from now. They've got uncertainty, and bottom line is markets don't like uncertainty, and that's the environment that we're in today.
Certainly, there's never any certainty in investing, but when you get this heightened level of uncertainty because the goalposts continue to move on a daily, if not hourly basis, like you say, Clark, it's impossible to forecast or model any sort of investment decision, business decision, capital expenditure decision across the board. But Jay, let's circle back to your point there, where in times of distress, generally what you see is this flight to safety, right? Where, kind of the three main asset classes that get bid up would be, one being gold. And you see that as we speak today on the recording, gold essentially at an all-time high. Number two, you have US Treasuries, as you said. And number three is the US dollar. Well, the latter two are actually depreciating or heading down. I think the US dollar is down some 8, 9, 10% year to date. Should we read too much into that? Or, a lot of commentators are saying that maybe this is the shift of lack of confidence or faith, as you said, in US markets or the credibility of the US government. Like, what should we take out of that? Or is it just on a kind of short-term anomaly that we're seeing?
I mean, I think part of that has got to be the fact that just the US dollar, the US market has been the runaway leader over the last decade plus. And there's been such a concentration of investment in the US markets. I mean, one of the things we've heard repeatedly over the last 5+ years from clients is, why don't we have more money in the US market? Why don't we have more money in US technologies? Technology companies, they've been such a clear winner and such an obvious beneficiary of some of the trends that we've seen over the last few years. And it's been difficult at times to defend the approach that we've taken, which is to stay diversified, to maintain exposure to different currencies, to maintain exposure to bonds, despite unappealing yields that they've provided in this kind of low interest rate environment. And so what we've seen, I would argue, to some degree, is a shift away from that concentration in the US dollar, in US stocks, and a recognition that in this potential new world order, you've got some new alliances being formed, whether it's with Canada and the EU, or Canada and Asia, or South America. And you've got these opportunities for countries, and I would put Canada squarely in that position, where you've got a relatively cheaper market, certainly in the case of Canada, an extremely cheap currency now. And if you can establish new trading partners and new opportunities to do business globally, it's not so obvious anymore that the US is going to be that clear winner going forward. So as we see with markets on a constant basis, money tends to flow where there's going to be better return on that asset. And I think that's what we're seeing to some degree. So you've got a previously elevated valuation within US assets. The US dollar has been the strongest currency for some time now. And now you're starting to get global investors looking elsewhere and recognizing there's potentially some opportunity, and this kind of change in policy is likely going to accelerate that trend, or at least make it a little more beneficial to be more diversified, which is something we continue to kind of fall back on in this kind of era of uncertainty.
I agree with everything you said there, Jay. And what I would add is I think there's something even simpler going on, which is, coming into this year, the expectations for the movement of interest rates in the States, we had such a strong economy, a strong outlook. I don't think there was any interest rate cut expectations for this year, just given the buoyancy of the U.S. economy. Now, with what we've seen and the uncertainty we just talked about, there's now the notion and the expectation that we'll probably see some interest rate cuts this year in 2025. I think there's 3 cuts, now built into expectations. And in the short run, currencies are highly dominated by interest rate differentials. So where you had the rest of the world, cutting interest rates, definitely not raising them, and the expectation in the US was the opposite, you've now got this expectation that things might be easing in the States. So that drives the currency down as well. I think there's been also a lot of talk about just broader selling of US assets for the reasons you mentioned, Jay, just diversification after a decade or 15 years of outperformance of the US. But, in an environment like we're in right now, where you've got trade war, particularly targeted highly towards China, a lot of other Asian economies that hold US debt, there's also this idea that there's selling of US bonds by foreign nations. That's probably part of the reason why gold's going up as well. They, sell US treasuries, put that money elsewhere into what they see as store of value. So I think there's a ton going on with the US dollar. But bottom line, and take a step back and think about what Trump's agenda is here, is he wants lower interest rates. He wants a lower US dollar. So, I think a lot of this is playing right into his hand. A low US dollar essentially makes US exports more attractive and makes imports, in addition to the added cost of tariffs, a low US dollar makes foreign goods more expensive as well. So, for Trump and the administration of the US economy, that could be a positive thing.
Coming into this year, as you noted, Clark, and I'll give you guys credit, you guys were pounding the table on the rich valuations that you kind of see skewed within pockets of the US market. So I think it was inevitable at some point we were going to see some weakness or a pullback. We've been doing this long enough now that we've experienced volatility. I think what we continue to see is the speed in which volatility, intraday that we see only continues to get quicker and quicker. But we've been through volatile periods before, and it's, the most recent one I'm going to say was 2020, when we went through COVID. You've seen that during the European debt crisis. You saw that in and around Brexit. You've seen that during the great financial crisis. Again, it's how you react to that volatility. And I think at times like this is why, we really try to keep our clients informed and be a champion of their goals and their objectives, because during bull markets, or when things are operating and on full cylinder, it's quote unquote, it's easy to remain invested. It's more challenging at times like this. That's why, we stand side by side with our clients, and again, champion what their goals and objectives are, not just measured on a daily basis, but on a weekly basis. Now, one thing you mentioned, Clark, I think it was yourself just recently there, on interest rates. You're starting to see a little bit more bark now about Jerome Powell should be cutting interest rates here. Now, the Fed has always remained independent. They're an independent body. They have been for 100+ years. Jerome Powell can't be fired by the administration. That has to go through court. But there's this pressure now that Powell should be cutting rates. Is he between a rock and a hard place right now?
Well, I think he is between a rock and a hard place. And I think it goes to just everything we're saying. It's uncertainty. So whether you're an investor or portfolio manager or a CEO of a business like we just talked about, you add to that list a governor of a central bank or the central bank head, is he doesn't know what the environment's going to look like a month from now. Generally, with data points, they have pretty good clarity on what the economy is going to look like, and they can react effectively with monetary policy. Like they don't know what things are going to look like. Now they've got two battling forces here, though. They've got an environment where these tariffs, basically they are inflationary. They are a tax. So we have the potential to see inflation rise again, whereas inflation over the last year has been under control. That would generally, when we are in an inflationary environment, they may actually want to raise interest rates to counter that. But what these tariffs are also doing is they're also having a weakening effect on the economy. We're seeing job losses from them. We're seeing job losses from other things as well. So we're potentially entering into an environment of stagflation, which is, and it's very unusual, is you generally, when you have economic weakness, the level of prices comes down. We could be in an environment where you have economic weaknesses and the level of prices go up. If you just think about tariffs. So in a period of economic weakness, they're going to want to lower interest rates. In a period of inflation, increase them. What do you do if you have both? And I think that's what spooked the market yesterday when he came out with the comments, and he simply, kind of paraphrased what he said. I don't have a clue. And we have uncertainty, and we have these two battling forces. And again, it just adds to the uncertainty out there. And how do you make decisions based on that?
But a rise in interest rates, the result is what? A stronger U.S. dollar, is higher bond yields in the U.S., which is exactly like you just said 5 minutes ago, against what the administration is trying to fend off right now. So it's kind of like this chicken and egg scenario, that tariffs are inflationary, which forces a slowdown in the economy, which pushes into recession. I think forecasts right now are 55-60% economists believe that if we continue down this path, it's inevitable that we do move into recession. You're seeing some recent polls that the U.S. public's confidence in how the administration is handling the economy right now is at the lowest level it has been. So you're starting to see some pushback. And again, if you're the central bankers, whether it's Jerome Powell or even Macklin yesterday out of Canada, he was of the same message. We can't make monetary policy decisions with all of this uncertainty. We don't know what things look like 72 hours from now, 72 days from now. So it's likely we're probably in an environment where central banks just hold firm on where they're at currently.
I think potentially until they get clear information, which essentially is less uncertainty. And I think that's what was mentioned yesterday. I think they will be on hold until then. That's what the Bank of Canada did yesterday. And that's what Jerome Powell from the U.S. Federal Reserve yesterday hinted at. And, I think ultimately we will get, we will get more certainty. When that comes and what is the catalyst for that, I'm not sure. But my guess is on this 90-day, it's probably now 75 to 80 days of tariff exemptions, after Liberation Day, when Trump said he's going to pause for 90 days. There's going to be a lot of trade agreements that are made. There's going to be a lot of tweets coming out from the U.S. or from the U.S. administration. There was yesterday that, Japan's trade delegation was there. And I think we won't necessarily have full certainty. We never do. But I think there may be a little bit more clarity where we're going with these tariffs, in the coming months.
Okay, we're going to play a game where every time you say uncertainty or certainty, we're going to put $1 in the jar for our lunch money. I think that investors, I mean, we're guessing which way this is going to play out with regards to the administration's policies. I mean, no one knows. That's very clear. Even Trump likely doesn't have a grand plan that he's sticking to. As investors, though, what we've got to recognize is that when we do gain clarity on what the plan is and how these tariffs ultimately are applied, the market will have already recovered, if not all, the majority of what it's dropped in this last month. And that's the analogous situation that we all rely upon. It's not a good investment strategy to sit on the sidelines and wait for these issues to be resolved, because by that point, the market will have already recovered. And so when it comes to what we're doing as portfolio managers, it's not that we're gaining any more clarity than any of our clients have at home. We just, in terms of what policy is going to look like and what effect that's going to have on the markets, we just have confidence that historically speaking, when you see markets go through volatility like we've gone through in this last month, it's generally a good time to be putting money to work with a long-term outlook. And that's really consistent with a lot of the messaging that we've been putting out to clients to say, we don't know which way this is going to go. We don't know when the market's going to stop going down, but we do know that based on historical situations that have been similar to this, like you said, Craig, whether it was COVID 2020, whether it was any number of the issues that have come along in kind of the 2010s or going back to the GFC, 2008, 2009, when you see volatility spike, when you see markets drop 20% plus, that's generally been a good time, and you've been rewarded as an investor bracing that uncertainty and putting money to work in those good businesses that we tend to favor. And that's really what we've been doing. So again, I don't think we need to kind of focus too much on which way we think that the administration is going to go. I think just looking at this from a kind of historical market perspective is really what hopefully our clients are counting on us to be doing through these challenging periods.
Yeah, you can't, it's impossible to forecast, as I said, or model any sort of the day-to-day information that's being digested. But what we can say is that everything that we know is discounted into prices currently. And if there was an expectation, and if the market is a forward-looking mechanism, and if the market was expecting more aggressive rhetoric and more aggressive tariff policy, the equity markets would be down even further. You'd be down 4,000, 3,800, whatever you want to call it, what level it would be at, which to me, that is a sign that you're going to see some sort of, I don't dare say common ground, but you're going to see continued reprieve on this top. Hit hard first, walk it back. Hit hard second, walk it back further. I can't get inside the mind of the administration, but I'm telling you, based off what we see right now, volatility is subsiding. And that's the takeaway, is that all of that negative news that we experienced 2 years has been discounted. And I think you're starting to price in, a little bit more of a less volatile environment going forward. And you're seeing that a lot of the indicators we track.
Jay's points are absolutely correct. They're very well taken. Is that it is periods like this, and I'm not going to use the word again, because it'll cost me $1, but the lack of clarity, I think I can use that. that's what creates volatility, and that's the point that I'm driving in, is that when you have that lack of clarity, it creates the volatility. It creates, and I will use it now, it creates that uncertainty. And it is those environments where you have it and prices are down as a result that you take advantage of it and assume that we will get to the other side, as we do all the time. And that's what we have been doing in portfolios behind the scenes. We're not going to make big shifts, big, huge tactical top-down calls, raising a bunch of cash just because we're in an uncertain environment. Instead, what we'll do is we'll make some tactical changes behind the scenes, security by security, to reposition portfolios so that when we do come out of this, that we've got the strongest companies coming out of this that'll emerge actually stronger. And and buying things that, because of this lack of clarity, you think about a company like Apple, it's one of the most exposed to this because most of the products come from China. It had a significant drop, and we saw the opportunity there to realize that value and increase our position. And those are the kind of things that you're going to do in this environment. And generally you come out of this stronger at some point.
Yeah, I'd still argue the core names on the US side of our portfolios, like you mentioned, Apple, Amazon, Walmart, JP Morgan, Microsoft, Alphabet. I'd still argue those are some of the best names, not just in the US, globally, that will remain core positions in our portfolios. And as you said, Clark, those are names that we were actually adding to for new money, for some new clients, and taking some profits off of some defensive names that have held up well. That's good tactical portfolio management decision making.
Yeah, or look for opportunities. I know, something like McDonald's and Starbucks. Starbucks, with a heavy exposure to China, has seen significant weakness in the last couple of months. McDonald's held up extremely strong, taking some opportunity to make a few switches there. And that's what you do behind the scenes, is just look for areas in this environment where, Jay, we don't have clarity, that and you can do that. And again, you come out with a portfolio that's even stronger than what you entered this environment in.
Well, the sum of it all is, like you say, we don't make market calls. We monitor markets. We use that as cues to how we manage positions and portfolios. But that is, when we make decisions, it's based off of the 26 names we hold in the US or 32 names that we hold in Canada. Again, that's just far better portfolio management. And that's something that is a process we have in place. And we've done that for 20 plus years. And that's not going to change, as we go through volatile periods over the next 5-10 years. We'll continue to improve the process, but we use volatility to opportunity.
Are you going to say, speaking of Canada, I was just going
to say, you want clarity or you want certainty? Well, what is it? 10 days from now, we go to the polls here in Canada, and I think that's often forgotten about here. There's a focus on what's happening south of the border. I think a very important upcoming event, obviously, is the election and what that looks like for Canada over the next 4 years. We haven't talked about Canadian election in a couple podcasts. Polling numbers are changing weekly basis. Where are things at?
Well, it's interesting what a few months can do. And, if you look back earlier in the year, I think the Conservatives were 25 points ahead in the polls. The Liberals, I think, had fallen to 19%, was it 19% popularity? And then you had a resignation of their leader, Justin Trudeau, and a new leader in Mark Carney. And that lead has completely evaporated, where the Liberals are now projected to have a majority. We all know that the only poll that counts is Election Day, but how quickly we've seen that shift, I think that kind of shift in percentages has not happened ever. The magnitude of that change in the last few months. And so I think that's where things lie today. And I'm just curious on your view, Craig or Jay, I've got my own, but what do you think drove that change so quickly?
Well, I mean, without a doubt, it's Trump's change in rhetoric towards Canada as an ally becoming now a foe, the tearing up of USMC trade agreements. And I mean, it's obviously unfortunate that we find ourselves in this situation, and politically, I think the winds have changed so much because for whatever reason, the Liberals have now taken the position of the better negotiating party. And that's in large part due to Carney's history and what he's been able to accomplish as the Bank of England chief governor, and some various other positions that he's held. But we have to kind of question what is going to be Canada's, like, over the next 4 years, depending on who gets in power, what is going to be Canada's position that we're going to take with the US, and how does that impact our economy, and how does that is going to impact markets. And I think what we've seen, forgetting about the polls for a second, is a massive shift in the Liberals' platform back towards the center. And I think we can all agree that that's going to be better for the economy, that's going to be better for markets. And if we can kind of continue to focus on creating as strong as an economy as possible, regardless of what the US's position towards us ends up being, that's going to be the best case for everyone. So I think we can all take some, cover in the fact that we've got at least the leaders of the Liberal Party and the Conservative Party singing largely from the same sheet of music at this point with regards to a friendlier environment towards resource development, more infrastructure projects, more tax benefits for investing in Canada, which has been one of the biggest problems over the last 10 years, as we've seen this massive flight of capital outside of Canada when we so desperately need it. So a lot of what both parties are saying at this point, to me, sounds very similar. We've got the English debate tonight, where we're going to kind of hopefully be able to see a little bit more of their different platforms kind of come to the surface. But I think whichever way this goes, we're going to be heading in a better direction than where we've been headed over the last 10 years.
Yeah, I think a couple things. One is, I think you're absolutely right with what we've seen go on in the States with change and how abrupt, how quick some of this change has been. I think that's causing a lot of people in Canada to take a step back. I think the other thing you didn't say, obviously, is the change of leader when you went from Trudeau to Carney. I think there was just
Interface.
Yeah, I mean, it was Trudeau, largely responsible for that decline in Liberal popularity, and with a new leader, I think that gave them an immediate bump up. But I think, coming into this year, I think what the notion in Canada was we, and when I say we, I just think as a country, we were looking for change. We've gone through a decade of I would argue, deterioration in our country relative to other places. And it was a popular message to, and this is what the Conservatives were doing, is to advocate change. And this is how we're going to change things. And with everything that's gone on, and you mentioned that, Jay, with tariffs and we're going to annex Canada and all this, I think, people are taking a step back from that change, and the Liberals are kind of communicating a message of stability. It's kind of more of a position of fear, and their ability to negotiate with the United States. And I think the Conservatives, again, were advocating all this change, and people are taking a step back there and saying, well, hey, look, maybe we don't need that rapid of change. Now we're in a position where we have to have stability, somebody that can negotiate with the United States. So I think that's where a lot of that has come from. And it will be extremely interesting in the next couple of weeks to see what the results are.
Yeah, it's interesting because it's from our perspective, when you hear some of these proposals that the Conservatives have tabled, and I think you mentioned a little bit on that, Jay, with capital gains, essentially having a tax-free holiday if those proceeds are reinvested back into Canada. And I haven't caught anything specifically from the Liberal Party on that front, but I think that's massively bullish for the Canadian economy, for the Canadian markets. That if you're a business owner that's looking at selling, if you got long-standing position in a Canadian investment and you can reinvest those proceeds back into a Canadian investment, that should just attract more capital to stay within our own borders. So again, I don't know if this is all hot air, but you're starting to see kind of these proposals that are coming out from both sides that they're pulling at the purse strings of majority of Canadians, in particular now the middle class up as well, that have a bulk of the assets.
And I agree with that. I mean, it's such good policy that they're introducing as part of their platform. That's the Conservatives. I think that's what we do need is lower taxes. We need a little less regulation, and we need to stimulate our economy. I guess what my concern would be, and it's kind of what I just said, is that unfortunately that message, I think, is being buried or hidden by the topic du jour, which is the US right now. And so we need that change. I mean, we've talked about this podcast after podcast. We need that change in Canada. But that messaging by the Conservatives, unfortunately, is getting covered up by everything else that's going on. Potential, when I say potential annexation, I mean, that's just a threat. But there's people here that are fearful of that, and they're fearful of what it means for their jobs with tariffs and a weakening economy. And that is the message that the other parties are messaging right now. And I think that's what's resonating in the polls. And it's interesting.
It's a pretty tight race right now as we talk. I think I looked this morning, it's kind of a 5.5% lead now for the Liberals, which a few weeks ago that was a 10-point lead. So it's going to come right down to the wire. And as you said, Jay, we're going to find out again. They're going to be on the hot seat tonight with the debate that you're seeing, I think, is out of Montreal. Clark, you just came out of Montreal. Got to think things were pretty tight there from a security perspective. But it'd be very interesting what unfolds over the next 10 days as we lead right up to Election Day. And another thing is look at what the advanced polling looks like from those who get out and vote early. That's usually a good sign as well of people are looking for change. So lots of moving parts to that coming up.
What's less inspiring is here in our Vancouver by-election, we elected two openly socialist people to council, which is hard to understand, but still, I guess, a healthy portion of the population openly calling for socialism to be the main party that we look to for guidance. And
never ever any shortage of politics to talk about. Let's reserve that for another podcast, and maybe we'll wrap up for this month. I think the message for today is lots of uncertainty. Put $1 in the jar for me. There's part of my lunch bill. Maybe we'll use that like transitory of 2021 and 2022. That's the new term that we're going to coin. But one thing is certain, we'll be back next month providing updates, another podcast. And as the events unfold over the next number of weeks and next 84 days, as part of this ongoing tariff conversation, we'll continue to relay all that information to clients as best we can. And as always, don't hesitate to reach out to us. Jay, thanks for letting me sit in the seat today. Hope you don't fire me. I'm going to give the reins back to you probably for our May podcast. So thanks for your time, everyone. And thanks for tuning in.
Well done, Craig. Thanks, guys.
Thanks.